In this problem, let's just refresh and discuss a contingent liability or a contingent loss. So you recall that there are three categories of a contingent liability, and what makes a liability a contingent liability is in essence, the liability has not happened yet. Its happening is contingent on some future event. So what we do is, based on the likelihood that the contingent liability will become an actual liability, that will depend on how we record it. So remember that if it's probable, if it's a probable contingent liability, then there's two things that we do. We record it in a journal, and so recording basically means, right, we debit some expense and we credit some liability. And then the second thing that we do is we disclose the information in the notes. So in the notes of the financial statements, we tell our investors and creditors about this item. All right, and of course, when we record, we call that an accrual, right? We're making an adjusting entry. We are accruing the expense and liability. If it is just possible, it's possible this would become a real actual liability, then we only do one thing, and that is we disclose in the notes. So again, the notes of the financial statement that supplement the four financial statements and tell our investors and creditors many details about our company. It would include that. And then, of course, the third one we classify as remote. If it's a remote chance that that this contingent liability will become an actual liability, then we do nothing. We don't disclose it, we don't record it, we don't mention it, we don't do anything. So depending on this likelihood, these are the items, how we would account for it. So in this case, if there is a probable chance, then we accrue, right, record in the journal, and report in the financial statements. That means disclose in the notes.